There we are. Good morning, everyone. Here from New York, Gary Werner from NextTier Real Estate Investors. We're an opportunistic value add investor on the equity side, focused on office, commercial, and mission critical assets, focused on connected investments throughout our platform. Looking forward to conversing with these fine group of professionals here. Looking forward to getting things going here. Nice to meet you all. Greg, would you like to give a quick introduction of yourself?
Sure. Hi, I'm Greg Breskin. I'm with Torchlight Investors, also live from New York, but not on Saturday night. We are a $4 billion investment manager. We are currently investing on behalf of Fund 7, which remarkably was raised entirely during COVID. We had our first close in June of 2020. And at this point, I think we now have just broken $2 billion in commitments, which is the largest fund we've ever raised. So it's kind of a remarkable testament to Torchlight's platform, of which I've been a part for 3 years. So clearly it's because of me. We are predominantly a debt investor, although we invest throughout the capital stack. We from stretched senior debt through mezzanine and preferred equity. And on occasions where we feel like there's the right risk profile, we also invest in JV equity as well. We tend to focus on more core plus and value add opportunities, although we also traipse periodically into the more opportunistic world, particularly with regard to being an active acquirer of distressed debt. On the debt side, we tend to be higher leverage, frequently lending as much as 90% of cost, and our returns are priced accordingly, given that we tend to travel the gray area between debt and equity as our last dollar quite a bit. So that's what we do.
Good stuff. And with that, we'll throw it across the country to someone who's probably on his first cup of coffee of the day. Got Chris Rising Realty.
Thanks, Gary. So Rising, I'm the co-founder and CEO of Rising Realty Partners. We are a vertically integrated real estate operator. We invest basically from Texas and Colorado west. We have 4 asset classes. We kind of more known for office, but we also have an industrial platform, a multifamily platform, and a data platform. Today, the portfolio is somewhere around 5 million square feet, just a little bit under. And we also do third-party property management and construction management on about another million, about a little bit more than 1 million square feet. We are a traditional GP LP investor. We do have an investment platform for LPs, mainly high net worth individuals and RIAs. That so we look at the world through a lens of value add and development on one side of the house, and core plus on the other side of the house. So that's Rising Realty Partners.
Fantastic. Good to know. Brad, bring it closer to this side of the country. Tell us a little about yourself.
Sure. Thanks, Gary. So Brad Lyons, Stabilis Capital Management. We are a New York-based debt fund. We specialize in short-term bridge loans, so stretch senior up to 75% LTV. Founded in 2010, we're deploying our 5th fund today. And most of our loans are 12 to 24 months, 75% LTV. It's typically an existing asset that hopefully had some cash flow pre-COVID, not necessarily cash flowing today. It's a whole loan that is contributed to the fund and held there unitranche through maturity. So we're not a CLO, we're not CMBS, we're not tranching stuff up and selling it off after the fact. Investor base is primarily, state pension funds, endowments, foundations, a handful of single-family offices. The second way that we deploy is note-on-note financing. So for a GP who's buying debt, potentially with the intent to foreclose, we'll provide up to an 80% LTC term loan secured by that first mortgage. Upon foreclosure by the GP, that first mortgage is extinguished. Our term loan then slides over and becomes the first mortgage in and of itself. Otherwise, all the same parameters. We're active throughout North America, South America, the Caribbean. We're looking at opportunities in Europe, historically been active there, and looking to kind of deploy more there as well. So that's kind of the summary of us.
Well, good. Sounds like we got a good balance here on our panel between the equity and the debt and geographies as well. Seems like we're all getting all over the place. I guess it's not been a boring last 12 months for any of us, I'm sure. Tell me, I think we all hear the buzzwords of the day. One thing that keeps coming up, it seems, in every podcast, every broadcast, is inflation. Where are you guys seeing inflation in your business models at all? Is it coming to the forefront, or is it just something that is a buzzword? What do you think about that, Greg?
You know, I think it's early in the game to see inflation. It looks, I mean, for us, it's more right now a discussion about what the impact of, you know, the combination of the recovery from COVID that will naturally happen anyway, combined with government spending, which is still to be discovered as well. You know, some of that spending is clearly going to drive the economy faster, and whether or not that's inflationary is to be seen. It feels like for 15 years now, we've alternated between talking about inflation and stagflation, and neither one has really occurred. So I'm starting to wonder, you know, what will it take to create one or either of those outcomes?
Yeah, I guess that's the thing about what expectations and perceptions always are, right? You know, we've been talking about fighting inflation since Paul Volcker, and we've been waiting for the day that it comes. You know, then there's perception and then real practices. Obviously, where you guys are investing on the debt is one thing, but Chris, tell me, in the equity side, your day to day, where is it creeping into your email blasts?
Well, it's very clearly, I don't think this is a surprise because there's news on it in timber. I mean, it is just absolutely clear. We don't do home building, but I yesterday had a meeting with a home builder who said they've seen in places like Idaho, places where it's more of a travel to get the timber to, that their costs have gone up 20-30%, and it's very much there. I'll tell you what we're seeing, most of our cost inflation is in drywall and in labor. In California, even in Colorado, things are just more expensive. I think there was a little bit of a COVID hike because you had to get people out there, but now I just think it's just settled in, and I don't see it going away. I can't see a factor that would drive anything down on any of these things, and so I think inflation is real. Whether it gets to the point we were in the late 70s, I don't know about that, but you can definitely see a trend line towards it, and it's something the Fed's going to have to address.
And what spooks you the most about it in terms of where you're underwriting?
Where you underwrite to, and when you close on a deal, and then from when you close on the deal to when you start your TIs or your CapEx, or when you start construction on development. There's these three phases that we you know, you're really just clenching your fists and you're hoping that the things don't spiral out. I can tell you that TIA costs, which I thought for sure, given all the emptiness in all these buildings in terms of occupancy and all of that, I thought for sure we would see TI costs go down. We haven't seen that. They've only stayed equal or gone up for a traditional build. And today a traditional build is a lot less millwork. You know, you're really doing interior offices, open space. That's not going to go away even with COVID. People are going to be a little more spaced out, but we have not seen any TI relief at all. And then your leasing commissions have gone up because you got to incentivize brokers in a way you didn't want to have to do. So now that whole line item on your Argus run is off by 5 or 10%, and it just is.
Yeah, 5% to the outside guy, right? Where it was, you know, we were negotiating between 3 and 4 a year ago. So Brad, you're taking it from a different angle, coming in from the bridge. How are you underwriting inflation and what you're looking at?
So it's less relevant to us. Just we're not really financing ground up construction unless it's a quick build, like, you know, industrial. And most of the assets that secure most of our loans are generally have limited CapEx. So less of an issue there. There's a longer term, just, you know, think about the sort of the toggle between fixed and floating rate loans. All of our loans today are floating rate, and just given expectations for what we're seeing and what we think is coming, it will remain that way. So 100% floating rate loans.
Well, so you're on the float, right? But obviously we're coming to a place where you were at coming out of record low interest rates, and that means that your loans are going to float in one direction. How are you accounting for the risk in terms of that, where you're competing for the cash flow, right? Chris has to pay the leasing commissions. Chris has to pay for those increased TIs. Where are you building it into your underwriting to account for that risk?
So I think that the thought process for us is really around look at lease duration, right? A lot of what we do is, it's hospitality related, it's multifamily related, less on the office side where you have longer term kind of call it quasi fixed income. So there should be a natural ability for our borrowers to be able to kind of, reset rents pretty quickly, should they find themselves in an inflationary period. And, I think that they're the beneficiary of that, as are we as the lender.
Mm-hmm. Mm-hmm. Good. So
yeah,
go, Greg.
So, yeah, I would just a couple quick thoughts on some of that. We're also on the debt side and also not doing construction. The inflation part on the costs, are more marginal for us than they would be for Chris, because we just don't have that much demand for materials, and the labor as far as construction goes is less meaningful. For us, it's more. I think it's more of a balance of inflation on your operating costs, which have a meaningful labor component, versus the speed of what rents are going to grow at. So it's sort of offsetting those two things. So one of the ways we're managing that, to your question on the underwriting, is less about underwriting that growth and more about investing in markets where the rent growth is more likely to outpace whatever inflationary pressures there may be. So we're looking in markets which are benefiting from the exodus from California, that are benefiting from the exodus from Illinois, that are benefiting to a lesser degree, but still an exodus from the Northeast. So unfortunately, it's driving a lot of us to the same markets, but the rent growth in time should offset. For existing product, it's much more of a risk in the short term, where Chris may get hit by the increase in costs and not really have a timeline that gets him the benefit of the rents.
Mm-hmm, mm-hmm, sure. So, Chris and I, obviously, we're, chasing a lot of deals. We know what we know, being equity guys. Sometimes you guys on the debt front, you may see activity a little bit differently than we do. Where are you seeing the opportunities in terms of the various product types, the major food groups? Where are the applications coming in from? Brad?
Look, so our fund is unlevered. So pricing for us, on a senior secured 12 to 24 month bridge loan is generally going to start in the high single digits. Looking across the competitive landscape, really from, I'd say, mid to late January. We saw tremendous liquidity coming back to the debt markets, specifically with the CLOs starting back up, and then certain banks coming back into the market broadly. So you saw deals where we may have been the only bid on in, say, October, November, or one of two term sheets. Suddenly, at the end of January, early February, you're starting to see a dozen term sheets show up on some of these deals. So just given our structure and given our pricing, we kind of have to be a little bit out there on the risk curve. So we found a lot of opportunity in hospitality, found certain opportunities in multifamily that was delivered, say, during COVID, that didn't really have the leasing momentum that you might expect. Retail, just not sure how to underwrite today, right? So that's a sector where we're generally looking for term and credit on the rent roll. Although it's interesting because you see these opportunities coming at 13, 14, 15, 20% debt yields, but you have to expect that gets whittled down over time. Office, just not sure how to underwrite it. Not sure what happens, not sure how to underwrite it. And then certain markets, specifically San Francisco and New York, really regardless of the sector, it has to be just an incredibly strong opportunity for us to be spending time on it at this point.
Well, Chris, you play around the office field a lot.
Yeah.
Still something you like?
I think, yes, long term, but I mean, there are some things we have to figure out. I mean, one of which is I was just on the phone with a partner yesterday. I don't care who underwrote one of the big Class A assets we own. I guarantee you nobody in that pro forma had parking dropping by 90%, parking revenue dropping by 90%. And, that's a hard thing to recover from on a 1.2 million square foot office building. And so I think there's some of these issues. I think another issue that we're starting to see is, every lease we had pre-COVID had a clause in there that said, while there's force majeure, you still got to pay your rent. While there's force majeure, you still got to pay your rent. And now some of these big law firms, they're pushing back on that. And I think, and the other thing that's just hit us out of left field is you have a major lease, it's coming up, they want to exercise an option, a 5 or 10 year option, and they say, we just want to do a 3-year option. Well, as the owner, I want to keep the tenant. The lender is like, no, that's not a qualifying lease, and we're going to have roll up our sleeves, and you're going to have to fund these reserves that the loan doesn't say we have to, but because now it's not a 5-year extension, it's a 3. So there's some of these very practical things that have to iron out. I will tell you that we track across 5 million square feet. We had 0 tours in November, December, and January. We're now averaging up to 8 to 10 a week, which is not quite pre-COVID level, but it's almost there. And what we're hearing resoundingly is that while people, resoundingly hearing people will be coming back to the office, and if they are not already, it may be a little different. I think I'm very grateful that I think dress codes are out the window. And I think work hours are probably standard 8 to 5 work hours are out the window as well. I think employers will say, we want you in. We have these 5 meetings during a day that are very important. Otherwise, whenever you come in, I care less. You have to get your work done. Kind of have some operational challenges between, what happens about after hours air, what happens to your rotation on parking and security. It's coming back, but the amenity wars were happening pre-COVID. They're only going to be intensified. That's for sure.
Indeed. Who would think that a law firm would chase after a clause that nobody really talks about all that much and says it's irrelevant, right? For sure. So Greg, what do you like in terms of deals you're seeing in product types? Do you have a favorite, and do you have one that you like to see go away?
So it's interesting how it's evolved. So Torchlight has always been an active investor in value add opportunities over time. And we've generally done it through high leverage debt. But given the world we find ourselves in, I would, to all the things we already talked about, I would add one other, which is our firm view is that in the intermediate term, say 2 to 5 years, the cap rates and interest rates probably have as much, if not more, downside optionality than upside optionality, in part because of what's happening in the economy, in part because of the pressure capital is bringing to bear by looking for places to invest. So we've shifted our investment focus some. We still are doing our traditional 85, 90-ish LTC financing on value add assets, although we have similar struggles with office that Brad talked about. But one of the things that a couple of the areas we started to focus more on is on assets where we think that cap rate compression we anticipate is most likely to come to bear. So where does that lead you? That leads us, for us, it leads us to 2 areas. One is we started doing more JV equity and higher leverage preferred equity and creative structures that sort of bridge those two in industrial projects. And similarly, we're doing both those same investment structures in newly constructed multifamily that are in lease up. So we've recently been investing in multifamily properties that have been completed in markets we especially like that are 20, 30, 40% leased, because we feel comfortable taking the lease up risk, but not the construction risk. And interestingly, one of the things we've done there in that world is, that business has always been lease it up and transition to an agency execution as quick as you can. And there's always been this push-pull between bridge lenders who want their money out as long as possible and equity investors who want to get out of their bridge loans and into agency debt or life company debt as quickly as possible. So what we've been doing to solve that bridge is we're doing both the JV equity and the bridge loan. So that debate gets somewhat simple.
Yeah, no, that seems so. You bring up the term cap rate compression, and you also use the word industrial in the same sentence. Is there going to be more cap rate compression in the industrial sector, or is it going to head the other way? I think that if I don't get a call from somebody once a week on one of my land parcels looking for a place for last mile, I'm getting two. So where's there going to be cap rate compression?
Well, I think for well-located industrial, there's so much capital chasing those deals that the cap rates are under a lot of pressure for existing product. And it's different pressure in different, depending on the lease structures from what we're seeing. Those with long-term credit leases, when you look at the institutional investors who are making allocation decisions, like life cos who are allocating between real estate and bonds, when you're buying a single A bond for a 1% return, but you can buy a piece of real estate with that same credit for the next 10 to 15 years and get a 4 or 5% return, it starts to feel more compelling, right? Right. So I think that's one area you see. Then on the multi-tenant industrial side, and Chris, being an owner, probably sees this more than I do, it's the revert. It's sort of a different answer, which is the demand for industrial space has risen so quickly in the post-COVID world. And, as demand has moved out of retail and into industrial, there's more pressure on rents. So people are willing to pay up more for the property, anticipating the growth in the rents. Again, it's very market specific, right? You're not seeing the same thing in every market. But I think between those two, you continue to see cap rates on industrial drop further. And I'm not sure what in the next 12 to 36 months causes that to reverse itself.
Chris, do you like any markets in terms of the industrial side?
Yeah, I mean, we do, and we're buying stuff in South Texas right now. We're buying stuff in Dallas. We really like Las Vegas. We definitely see a play between the grade level industrial and the dock high. I've never cap rate compression in the dock high stuff is just, if it's brand new and it's got some height to it, it's unbelievable. So the opportunities we see are away from that. It's harder to convince capital why it's a good play, but we have a strategy on how we can reposition those kind of assets, and we've got some big name partners who are backing us in that. I'm a firm believer. Look, I'm an optimist always, and I'm a California guy, Los Angeles guy my whole life. But while we have some problems here, we still have almost 40 million people, and there's opportunities here in California, and we're gonna find them. But I'm really big in the mountain states. I think the Utahs, and I put Nevada into that, even though it's more of a dead because of the Reno area. And I just think Denver. I think these mountain states have a lot of runway, because I think they're going to be a natural offshoot from Silicon Valley and the VCs, and them saying, hey, go put an office there and move people there, and they're not heavily populated right now. So you go to the state of Idaho, you bring in an employer that can bring 10 or 20,000 people. That's a huge impact. So that's where we see growth in those, on the industrial side specifically.
Now, what about bubbles? Are we seeing any bubbles out there, Brad? Anything coming across your radar screen that concerns you?
Yeah, I mean, of course. I think my number one concern at this point is just the amount of liquidity on the financing side of the coin. You have, I mean, there's so little traded in 2020, so little got financed in 2020. Basically, you've got an entire industry that seems to be trying to work through 2 years of activity in, I don't know, like 9 months, 10 months, something like that. That you wonder how some of these opportunities or some of these deals that are getting done right now are gonna pencil, and how they're gonna look in 12, 18 months from now.
Sure. Well, I mean, I'm a recovering appraiser. That's where I started out. And obviously, everybody blames us for always looking at the rearview mirror. And, if you're talking about price discovery, how are people finding out where these deals should settle? And what's the difference between pricing discovery on the debt side and the equity side? Greg, what are you finding?
No one has any idea where prices are.
And I think that may be one of the smartest things I've heard anyone say in the last 12 months, because it seems like everybody's an expert every day in my email blasts. But tell me,
So I would tell you, especially on the multifamily side, in multifamily for the last 6 months, on the sales, since we're in both equity and debt there, we sort of see both sides of it. I think every pre-marketing package that's gone out, every broker who's told its sponsors where their property should trade, is because they're done just because the market's moved so fast, has been horrifically wrong, to the sponsor's benefit. So I mean, we've seen deals where we had one deal in November where the whisper price pre-bidding was between 73 and 74 million, and the property traded for 78. We've seen office deals where there's a really compelling thick mezzanine tranche on an office deal. It was a value add deal that had a low leverage life company senior in place, so that's why it was mezzanine. And pre going to market, the whisper was they thought that mezzanine piece was going to trade plus or minus 8%, and it ended up getting done around 6%. So it's, as Brad said, the liquidity is so large that people have been wildly wrong, and not, again, just because we're in places where the data doesn't support. Every multifamily deal, every industrial deal is pricing on a per square foot or per unit basis higher than anything ever has. And
so
it's paid to
like every day.
It's paid to wait. Like it's a GP's market right now. It's absolutely paid to wait. If you had maturing debt in 2020, and the lender was rattling the saber, which very unusual for that to actually happen. It's just paid to wait, just string it along, and the market has become so strong that on the debt side, on the equity side, it's a great time to be a seller, and it's incredible. There's so little distress relative to what actually happened in the real economy, and now I'm looking at hotel. We don't do hotel construction loans, but now I'm looking at all these hotel, because just like hotel deals weren't getting done, and so now those are getting done and priced incredibly tight. And then sort of the next wave there is hotel construction loans, and those are starting to get done now too. So it's just amazing where we are.
And by the way, that's really remarkable, because the one area, hotels is sort of this funny anomaly as an asset class, to just to build on Brad's point, in that the next 12 to 18 months are going to not be great. With some confidence level that 4 to 5 years from now will be just fine. What the path from one to the other is really hard to forecast. So given that hard to forecast, layering on construction risks just seems like an incredibly courageous position to take.
So let's say you had a blank check and you didn't have to go back to your investors for approval. Is there anything that you would go after tomorrow without thinking about it?
Sounds like I should be buying Chris's industrial portfolio.
I'm a big believer in data. I think it's continuing to, it's an interesting business. It's a power business, and I think it's only going to improve. And people have moved to the cloud, and that's not going to change. And that takes a lot of power, and no matter what they say, software has improved latency, but latency is still a factor. So being near big MSAs with data centers, I think is a really good play.
No, we couldn't agree more with you.
Yeah, not to be flippant, the real quick answer is I like hotels a lot, existing hotels a lot, because for good or ill, Amazon, at least so far, hasn't figured out how to sell hotel rooms.
Sure.
So Chris is on the other side of
it.
Gary, what are you saying? What am I seeing? Where's the opportunity set for you?
we think that being in and around places that are close to major healthcare campuses is a great thing to be. We don't profess to be life sciences experts, but it's one of those things where we think that it's like a rising tide. It brings all the boats up as well. So we try to look for properties that are proximate to those things as well. And to Chris's point, we look for, as part of our brand at our properties, we call our properties NextTier Connect, connectivity, whether it be fiber connectivity, power connectivity. We've got a strong background in the data center area, but we don't pretend to be a data center. We like to have things that are closely associated with them, because as we're seeing in this world where we're all connected via this virtual platform, this is going to be a part of our life going forward. It won't necessarily be our life going forward, but when you have now 200 300 square feet per person and everybody's zooming something per day, being able to make that connection is important, and that connected building is crucial to that. And we're redefining what infrastructure is, much different than it was 10 years ago. So those are the things that we look at, because we're the things that's going to drive our world. Are you guys playing in anything where you're concerned about ESG at all? Is that factor into your underwritings?
We're actually very big in ESG. In fact, it's a huge part of what we do, whether it's industrial, multifamily, or office. We have some copyrights and some protections around some of the tools we use. We have our own scorecard we share with our investors. I think there's nothing more important, and I think technology enables this, than the ESG. And every investor we have and every investor we go after wants to hear a story around it. And I just don't think you can make it up. You have to really have expertise around it. So, we bought a triple net building just recently that's office and it's industrial, and we've started the solar program. We've started putting in the electrical, and we report all of this. And we're just getting ready to go out. And we had commitments on a big fund pre-COVID. Maybe value add office with an ESG focus isn't as popular, so now we've expanded it and we're going to go back out to the market. But I just believe it's like technology. Every business is going to have a story around it to be able to raise money.
Sure thing. And keeping the carbon footprint down to a data center is a tough thing to do, but I guess you got to try where you're going to try to do it. On the debt side, how do you guys manage that ESG issue at all? Is it possible?
Well, I have a quick question, I guess, for Gary and Chris on that.
Yeah.
Are you seeing it in tenant RFPs increasingly?
Very much so.
Are tenants looking for it more?
Very much so. So like at our Class A assets and our Class, you don't really own anything B. We have a building-wide app. That app birthed out of interaction with the tenant. It's now evolved into where we're putting what the air quality is. We're providing a center for people to be able to see, how much outside air is coming in, what's the level of particulate, all of these things. We're starting to feed into it because tenants are asking these questions. And it's amazing to me, having been in this business a long time. I've been at the ULIs where people scoffed and the brokers said it didn't matter. Almost every RFP we get from a credit-worthy tenant asks about, is the building LEED? Is it fit well? Is it well standard? What's your wired score? What's your walk score? And we have a whole scorecard that we share. We don't necessarily share that with the tenants, so we probably will as we keep going, but we certainly share it with our investors so they know that the day we bought this investment, this was the carbon output. Year to year, this is how we've brought it down, and here are all the problems. The hardest one has been social, and we think one good thing about COVID is it gave us some time to go out and find a measuring stick on social, and we think we've partnered with a group that's going to solve that for us. But how do you? We did some basic things, like we'd open up conference rooms for high school students to have access to broadband, and we did food drives and things like that. But we're trying to take it to another level. But it just, every RFP we get, there's a question about what's your ESG. That's just
Yeah,
where we're
no,
at.
there's we look at it less from the idea of, putting a sticker on our buildings to tell people what they are. But to Chris's point of getting out there in the market and the community and understanding what the stakeholders need and want by your involvement really helps us, because we think that that's how we lease our buildings. It's that you're part of the community, and that builds its own brand around you there. But to the standpoint of hearing words like particulates in a RFP, yeah, people are wondering who this guy Merv is and what he has to do with airflow, but it's coming all the way through in terms of the more social side of things. From what we've seen, those touch more when we get involved with government related leases, as there's a little bit more thought that goes into those things, and the more institutional users, the people who are, called more entrepreneurial groups, they're a little bit more focused on their immediate environments. And that's what we're seeing come in through our RFPs.
So the answer to your question for me on the debt side is that's sort of what I expected. So for us, it's a second day effect, not a first day effect, because we're more passive investors, whether we're equity or debt, but especially as debt. But for us, the second day impact is less about the environmental impact and more about sponsors like yourselves' ability to attract tenants in the long term and to drive rents in the long term. And the more, those kinds of demands on the investment grade tenants is surely going to trickle down to smaller tenants. So I think over time that it'll impact the value of buildings. So we care about those things mostly in terms of being able to evaluate both downside risks and keeping buildings full, and upside opportunities in terms of driving rents as much as anything.
And is there, switching gears a little bit, where are you getting your money from? Raising capital opportunities is, I think we've talked of there being a lot of dry powder, but is that on the leading edge in terms of you seeing maybe a pivot in terms of where you should be looking for deals, where how the capital raising market's doing for you? Brad?
Look, so for us, we typically are investing one fund at a time, and we're working our way through deployment of Fund 5, and then eventually, as we get to the tail end of the deployment, obviously we'll be out in the market for the successor vehicle. Just saying the capital raises that have gotten done, particularly look at Greg, and Chris has been in the market as well. It's been, the capital raise market has been incredibly robust, given the level of dislocation in the economy. And I think it's just a testament to how much capital has to get put to work. Then tying it back into the ESG side, I think to the extent that a sponsor has the ability to define a particular strategy that might be differentiated from maybe their core fund, I think that there is definitely an opportunity to raise separate accounts around some of these, I wouldn't say niche strategies, but some of these more specialized strategies.
Yeah, for us, since we just raised $2 billion in 2020, I would say we're doing the same thing we've always done. One of the things I find that's different about Torchlight than a lot of other folks in our space is, we invest in CMBS, we invest in investment grade bonds, first loss tranches, we invest directly in senior debt, mezzanine debt, preferred equity, JV equity, sort of a broad range, but we don't have an equity fund and a debt fund and a bond fund. We just have a fund, and all of our opportunities go into a single fund. So it allows us the flexibility to move where the best risk adjusted returns are in the market. And, through 7 funds, I think the track over 25 years, I think the track record speaks for itself pretty well through up cycles and down cycles, which is why, despite COVID, we had our most successful fundraise ever. It's just a strong team. I get the least credit for it because I'm neither a fundraiser and I've only been with the company for 3 years, but it's sort of an impressive capital raise. But we're getting from the same folks we always have: pension funds, sovereign wealth funds, municipal and governmental funds within the United States, and remarkably little overseas. 90% of our capital, I think I'm told, it comes from domestic sources.
Well, congratulations on that. Chris, you're out there. You're not far from a gateway city. How has, especially in the last 12 months with everything that's gone on, changed how you think you're going to raise capital in 2021, 2022?
Well, I think for us, there's two issues. One, we would like to control our own capital as much as we can. It just makes life a lot easier. But you balance that against the fact that some of our partners have raised so much money and they have a need to get it out. And, our list of LPs for, the private, the guys that do what Greg does, and, is much longer than it used to be. So you kind of balance the two, and you say, if you have the right partner and I don't have to go get on airplanes for a year, maybe that makes more sense. Ultimately, we're going to raise our own capital. That's the vision. In the short term, we have a strategy that we're working on with a private equity real estate group that we had 2 or 3 people bite at it pretty hard around an industrial strategy. So, if it's there and there's people out there, we're fine putting up our 5 to 10% and having them there if we can do more deals. It's a little frustrating if you only get one deal done because it's a lot of time and effort on the dots. So you want to try to find someone you can do 3, 5, 10 deals with. A lot of capital
nice to be
out there.
Programmatic. Keeps the legal fees down.
Yeah.
But I guess we could make a lot of lawyer jokes, but nothing personal, Chris.
I wasn't very good.
Well, it's myself being a utility infielder, it's not about being good, it's about being consistent.
That's right.
Yeah. Now, I think we've touched on the term of distress at all. Is any real distress investing going on out there? Are you guys backing anybody on the debt side that's chasing anything that you've seen success in? Or is it all, if you see it that it's actually distressed, is it just a falling knife? What do you think about that, Brad?
Look, our approach to distress this cycle is different than it was last cycle. So last cycle, you would have seen us go out and buy, a couple of $1 billion of commercial real estate distressed debt. We would buy it solo, go get in there, work it out, and if we had to take the asset back, we would. If there was a way to do it without doing that, fantastic. Today, we very much prefer to be backing a GP who's coming in and buying the debt. So we're in a, there's fresh cash equity coming in, call it 20-25% cash equity coming into the deal. We're approaching it from a note on note perspective, but just debt, right? Straight debt. Distress, where is it? We've executed a handful of trades where, GP has gotten access to typically small opportunities where there is an ability to get in there, work it out, and have a nice recovery. But just not seeing sort of the scale of opportunities that I think we all had expected to see by this point. So it's interesting. I mean, the banks, certainly there's no pressure on the banks to sell at this point.
I think there might be some opportunity in some of the states like California that have had this moratorium on evictions because they're still going on. And so nobody quite knows what's there. I don't think it's a huge nationwide opportunity, but I think in the states that have continued these eviction moratoriums on smaller office, where you have less credit tenants who, what we found is when PPP is available, they can pay their rent and all that. And when it's not, they don't pay it and you can't evict them. And I've certainly, we haven't, nothing in we own, but I've heard on the multifamily side, there's a whole wave once the evictions go away, where most landlords are going to go to those tenants and say, look, you rent $1,500 a month, you owe me 10 grand, why don't you just leave? And we won't, and we'll see what that happens, because you can't really chase those people for money they don't have. But as I said, I don't know if that's not a nationwide thing. It's in the states that have them, in the counties that have the moratoriums. So we'll see how that plays out, because I think by June or at least September, those are going to go away.
Yeah.
Yeah.
So from the multifamily side, as an owner, we have exposure to 20-something thousand units across the country. I think September would be optimistic. Our view is that it's probably going to take till year end because of the backlog. And also, to your point, it's market specific. I think the answer is different in places like Florida and Texas than it is in New York and San Francisco. The biggest impact on rents we've seen, it has been in the more regulated, pre-COVID regulated markets on the multifamily side. But in terms of stress, look, Torchlight's always been a very big buyer of distressed debt. We're, as a buyer of B pieces and CMBS, we have a special servicer, so we have good insights into that. But all the incentives right now have been running to lenders being patient. And I think that, to Brad's point, lenders have benefited from being patient the way because GPs are benefiting from being patient. But it's not that different from the Great Recession, in that if you look back at the volume of distressed debt trades back then, the first 6 to 12 months after the Great Recession hit were relatively underwhelming in terms of the opportunities. The second year was when the lenders started to lose patience. There was enough recovery that they felt like they weren't going to have to sell for 50 cents on the dollar. Maybe they could do better, barring something fundamentally wrong with the property. But, just decent properties have been adversely impacted. I just don't think we're there yet. I think, there'll be a more active distressed debt market in 2022 than there will be in 2021, as lenders feel more freedom to do what they got to do.
Yeah, well, I think that comes back to the term pricing discovery. That's just the market discovery, right? I think we didn't find anything on the debt side that was worth actually buying until 2011, 2012. So what was that? At least 2 years, 3 years, right?
Right.
Who knows right now, back to your point of what's going to survive in the retail markets. What is retail going to look like now that people are opening up again? From the ownership side of things, we're probably going to see some changes in the tax code. I think we'd agree what they are and where it all shakes out. But to your point of markets that you like, what are those states like Florida going to look like in 2 years if you see something change in the SALT tax? Any thoughts on the tax code, Chris?
Well,
California.
Yeah, I think on the SALT tax, you've got the Speaker of the House from California, you've got the Republican Party House of Representatives lead from California, you've got the head of the Senate from New York, and you've got the Vice President from California. I have a strong sense that they are going to fight hard to bring back the SALT. And quite frankly, I think the 39% proposal on capital gains was just that. It was a starting point. But I'd trade to bring back my SALT protections and see a little bit of increase in the capital gains if that's the trade I was asked to make. And who knows? I mean, I think it's a dysfunctional place, and I don't think the Democrats have a very strong hand to make anything of a major change. So I think it'll be around the edges, but hopefully SALT's part of it.
Well, they always say sooner is better than later, more is better than less. So all depends where you are and whether it's an inheritance you're waiting for.
Yeah.
Anything on your guys' mind before we step into the question and answer segment of our conversation here? We've got a few questions lining up. Brad?
Yeah, look, it's just from where we sit today, it is remarkable just to see the strength of the commercial real estate markets, the amount of liquidity, the resiliency of a lot of these sectors, of a lot of these GPs. To your question about retail, where does that? I mean, look, we've been talking about this for a dozen years now, right? And it just feels like the past couple of years, it finally kind of came home to roost. We just closed on a small grocery-anchored retail financing in far northern rural Wisconsin, actually with a relatively near-term lease roll for the grocer, but there's no place for them to go. We know they want to stay. It's a good store, very productive for them. But thinking about retail, like super regional malls, and you think about sort of the retail to industrial trade, the retail to self-storage trade. I think there's going to be some creative uses in that sector, and remains to be seen what happens.
Yeah, well, walk around any mall that you probably walked around how many countless times over the last 25, 30 years as we're starting to date ourselves, that they don't look like they looked back when we were in high school, do they? So, you got to expect a change, and what that is, who knows, but that's why there are retail specialists, and I'm definitely not one of them.
I think I'd also, just to pick up on that again, like obviously there's early adopters, there's folks who were relying on Amazon a ton, right? Pre-COVID. And then you still had folks who were just accustomed to getting up and doing their weekly grocery run and going in and spending, I don't know, an hour and a half, 2 hours, however long it takes to do the grocery run. And I think, so you had those folks who were just kind of entrenched in sort of that lifestyle. Anybody who kind of got the shove to do the curbside pickup during COVID, I think to the extent you can pay an extra $2.50, $5, $10 for somebody to go spend the hour and a half to 2 hours to actually pick all your groceries, and you're comfortable having somebody pick your groceries. I think that stays, right? So I think that retail distribution, I think you're going to get a whole level of adoption that happened during COVID that's distinct from the pre-COVID. And then higher education, also just a sector that is starting to get a lot more attention. At Stabilis, we've been of the opinion that a lot of these colleges, for probably 5 years now, are excellent candidates for bankruptcy. And I think that you're going to, if world-class education or a world-class lecturer in a particular subject or a topic that you have to take in college is only one mouse click away, why would you tolerate average from this particular professor at the school that you happen to be going to? So I think that higher education necessarily must transform in a dramatic way, just because I think people have become or are becoming more accustomed, and there's an expectation of more choice and higher quality delivery of material to students.
Oh, come on. I'm really enjoying sending $70,000 a year to Wake Forest. I know. Why would you change that?
Yeah, well, as long as they send you the shirt, that's all that really matters.
Actually, not to digress, but the fun was when I wrote the first tuition check the first year, and 3 weeks later got a fundraising request for additional contributions, and my wife stopped me from writing a letter back saying, "Wasn't the tuition check enough?"
Yeah,
but to Brad's point, I do think that away from, I think grocery is probably okay in the long run, because like I'm a food person, so I like picking which orange I want. And my experience with the delivery services, they grab the 12 oranges that are on top, not necessarily the 12 oranges I want. But when you get away from it, it gets more complicated. So for example, just this morning, I was looking around, and there's a few light bulbs out in my house, and I'm like, geez, I should run over to Home Depot and grab a light bulb. Then I'm like, well, maybe I don't need to. Maybe I should just go on Amazon and order the light bulbs I want anyway. And I'm not sure which one I do today. Yeah, but I'm not sure where I shake out on it at the end of the day. But there's millions of people making that decision every day, and increasing numbers are saying, I'll just order on Amazon.
Sure.
Especially if you're under 40. If you're under 40, I mean, that's why I don't know if people understand that people under 40 live a much different life than those of us over 40, because they've just brought up with it. But if you're under 15, it's even more different. And I don't think it bodes well for the idea that someone's going to go grab some light bulbs. I think that's just not going to happen. People are going to order them.
And
yeah, and then I'll just connect that back to Brad talking about education, though, and then the transformation of that is that, paying attention to those people that are under 40, for us to be at the leading edge of trying to invest in markets, we need to understand the mindset of people who are going to be changing the market in the future. And, you know, not just being dictated to in a classroom, but participating in the classroom. You know, that's something, it's a choice that people are going to have to make, just to the same extent that you'll have to choose whether you want to go to the grocery store or whether you want to order it on Amazon. What are you going to get out of your experience? That's definitely something we need to keep our eyes on. Got a couple of questions here. Where do any of you see an opportunity for high risk, high ROI in angel investing? Chris, that might be something that might be closer to your bailiwick.
Oh yeah, well, I mean, I think there is an opportunity as crowdfunding continues to mature, and as people like ourselves build out our investment platforms, we're taking on more outside money to invest, and just doing it by trying to skip out the middle person. We've had some great success doing that on the LP side. What we have found is that the higher risk, no current cash flow deals are very unpopular, no matter what the multiple is. I also will tell you that the lower risk, lower cash on cash is unpopular. There's kind of a sweet spot on a cash on cash that the LPs want to do. We've done a deal with CrowdStreet. We've done deals with, we're talking to all of them because we just believe it's not going away, and they have very sophisticated systems, and people are investing that way. So that's where I see that opportunity. Or it's going to be the same old, do you play golf with the developer, or do you know, are you in Rotary with the developer? And maybe that's a way in, but those are the ways I see that, kind of, to answer that question.
Good. Good. Well, I think we're coming up against the clock here. Anybody like to say anything to close out? Anything that you're going to be doing that, you know, you think is, let's say, different from the herd in terms of investing? Any ideas, Greg?
Well, I think the different from the herd is tough today, because the herd sort of we're all reading the same map to a large degree. But I think one of the places we've tried to differentiate ourselves is by providing a full stack solution that's not securitized. You know, one of the challenges I think a lot of sponsors have, and I suspect Gary, you and Chris have both seen this, is, you know, be it a CMBS loan or a CLO loan, that structure imposes a lack of flexibility. And a lot of projects have unexpected needs along the way that flexibility creates a problem for us. So for us, you know, we've tried to solve that problem by keeping everything, like Brad, everything's on our balance sheet. And we do both the senior and the junior piece more often than not, because, well, frankly, for us, it's better downside protection. And for the sponsors, by not being stuck into a securitized product indirectly or directly, it gives you more flexibility. And frankly, if things go awry, it's just the two of us. It's not some disinterested senior lender with different needs and wants along the way. So I think that's one way that we are a bit different from a lot of our competitors. We go higher leverage than other senior guys, and we'll do both the junior and the senior, unlike a lot of junior guys. So I think that gives us some advantage.
Yeah, there's definitely a you know, trade-off there. You need the flexibility, but of course, being a smaller guy, you know, being able to build up those relationships that are going to travel with you through all the different markets is a tough thing to do. So sometimes we get stuck having to deal with imperfect solutions. Well, Chris, anything in terms of you know, your debt relationships that are you know, driving you nuts these days?
I will tell you that I once again had to learn the lesson that I should never do a CMBS loan. I thought I learned it from my time at McGuire Partners, but you know, it was so attractive when the world looked great, and now we're in a world of hurt. And I realized that servicers' only reason for existence is to try to create some way to get a fee, special servicers. So it's very painful, and I, you know.
And they're really good at doing that, creating the pain. And finally, from our questions list, in terms of the office market, Chris, are you seeing, with flexibility being something that's built into the vocabulary of everybody as an office user, how's that filtering its way into your tours, and how are you speaking to that?
Well, I think we're going to go through a shift here. I mean, it's been coming since, when my dad was in the business, and you could do a 15 or 20-year lease with IBM, and now we're down to the standard being kind of a 5 or 7-year lease. I see that being driven down even further, and the financing markets are going to have to get comfortable with the idea that office is going to have kind of a standard 3-year lease, and some people are going to get a 1-year lease. And the people who have the biggest balance sheets will be able to do it. And we're not, quite frankly, one of those at this point. If I think Irvine Company with their balance sheet could be a leader in doing 1 to 5-year deals. And I think that's what people want. And at some point, the market's going to give them what they want, and will rationalize underwriting differently than long-term fixed income, but that's what the market wants.
Yeah, well, it's what the market wants, but unfortunately, when you've got a loan where you're on a value add investment and you're underwriting to net effective rents, how do you get a net effective rent when you start compressing that term?
Yeah, well, there's a good if anybody's interested on Twitter, there's a Sam. Oh God, I'll have to come up with it. But Ryan Simonetti, I know, reposted it. Another way to look at how you underwrite office in a world with flexible lease terms, and maybe you get away from the standard cap rate analysis, and it starts looking a little bit more like hotels and things like that. So I think there's going to be a new metric to how you underwrite a deal, because when it's one thing to say, hey, I won't do this short-term deal with a startup, but when Nike comes to you, and when Microsoft comes to you and says, look, I'm taking 100,000 square feet, but it's going to be an 18-month lease, take it or leave it. I mean, people are going to say, I'm going to take it. And just, in Japan, most of the leases are just 30-day or 1-year leases, and they just renew continually. So there are markets that do this, but the American market hasn't gotten there yet.
Yeah, well, cash flow is king, and occupancy is great to support cash flow, right? So getting those vacant spaces filled up may take priority over some of those other underwriting metrics. And that being said, as we talk about flexibility, and also we go back to attorneys, always the sign of the bottom of the market in New York has been when the law firms get out there and start signing leases for a long term, because those people where the cash flow hits the bottom line are the partners, and they want to lock in their low rate. So it'll be interesting to see how long that flexibility word lasts in this market, and how long it sticks and where it stays.
All right.
Well, good. I think we've gotten through our questions. Marina, how are we doing on time here?
I think we are wrapping up. If there's anything else that you would like to add, please do so. If not, we can just wrap up right now.
Yeah, no, this has been great. Enjoyed our conversation, guys.